Welcome to my video on monetary policy. Monetary policy is about controlling money. Monetary policy involves making decisions about interest rates, the money supply, and exchange rates. Monetary policy has a huge effect on aggregate demand, and it's a demand-side policy. It is also a short-run policy. Please note that it has a huge effect on aggregate demand in the United Kingdom because 60% of all aggregate demand comes from consumption. The most important tool of monetary policy is the ability to set interest rates. Changes to interest rates affect borrowing, saving, spending, and investment. Interest rates also affect the other components of monetary policy, the money supply and exchange rates. For example, a high interest rate can restrict the money supply as there'll be less demand for loans because the interest rate obviously acts as a disincentive to take out loans. Moreover, an expansion in the money supply will mean that the interest rate is lower and consumers will be more willing to take out loans as the cost of borrowing falls. Monetary policy can therefore be either contractionary, which means tight, or expansionary, otherwise known as loose. Contractionary monetary policy involves reducing aggregate demand, using high interest rates, restrictions on the money supply, and a strong exchange rate. Alternatively, we have expansionary monetary policy. This involves increasing aggregate demand using low interest rates, fewer restrictions on the money supply, and a weaker exchange rate. Contractionary monetary policy is used when we're suffering from demand pull inflation. Expansionary monetary policy when we wish to increase economic growth and increase the number of people in work. Monetary policy cannot achieve all of the government's macroeconomic objectives simultaneously. There's going to be a trade-off. For instance, using monetary policy to increase economic growth, that is, expansionary monetary policy and a reduction in the interest rate, may well reduce unemployment and increase the level of GDP, but it's likely to increase demand pull inflation. And because there's inflation, it's likely that we will export fewer goods abroad. Also, the high price level will mean that we import more goods from abroad, therefore worsening the position of on the current account, on the balance of payments. In the UK, the main aim of monetary policy is to ensure price stability. That is low inflation, but please do not forget that the Monetary Policy Committee at the Bank of England is also tasked with achieving economic growth and reducing unemployment. Interest rates are set by the Monetary Policy Committee. The Monetary Policy Committee of the Bank of England sets interest rates in order to meet the inflation target that's set by the government. This target is currently 2% inflation as measured by the Consumer Price Index. This is known as inflation rate targeting. The MPC has a symmetric target. If the inflation rate misses the 2% target by more than 1% in either direction, i.e. if it's less than 1% or more than 3%, then the Governor of the Bank of England has to write to the Chancellor. So, if the MPC believed that inflation was likely to go above 3% with current interest rates, it would increase the official rate of interest. We sometimes call this the base rate, to reduce aggregate demand and keep inflation close to 2%. It's worth noting that the European Central Bank aims to keep inflation close to but below 2%, We call this an asymmetric inflation target. A low rate of inflation that's stable and credible, that is trustworthy and accurate, stops higher rates of inflation becoming embedded in the economy. Embedded meaning that workers will expect proportionate increases in their salaries to the inflation. So for example, if inflation increases at 2% each year, and that's what workers think, they will demand pay rises of 2% every year. So it also helps a government, that is the inflation target, it also helps a government achieve macroeconomic stability. That is, a high or rapidly changing rate of inflation creates uncertainty. They do not want this. The Monetary Policy Committee do not want uncertainty, because this prevents investment and makes it difficult for firms to plan for the future. To achieve this stability and credibility, the Bank of England is independent and accountable. The Bank of England's independence means that interest rates can't be set by the government at a level that will win voters, but which might not be right for the economic circumstances at the time. The Bank of England is also accountable. If the inflation rate is more than 1% away from the target rate, either above or below the 2% target, then the bank's governor must write an open letter to the Chancellor explaining why, what action the MPC is going to take to deal with this, and when they expect inflation to be back within the 1% target. Although price stability is the main objective of monetary policy, the Bank of England must pursue this in a way that doesn't harm the government's other macroeconomic policy objectives, e.g. economic growth or low unemployment. When the MPC is making a decision on interest rates, it will look at important economic data, such as house prices, the size of any output gap, and whether negative or positive, the pound's exchange rate, the rate of increase or decrease in average earnings. So for more information on the factors that the MPC considers, please look at my notes. Interest rates have to be carefully considered in the UK. There is a huge possible ripple effect. The ripple effect is linked to the transmission mechanism, which I will discuss later in this video. So, even though small changes in interest rates can create a ripple effect through the economy, there is likely to be some immediate short-term effects. For example, if there is an increase in the interest rate, you will see borrowing decrease, investment decrease, consumption decrease, confidence decrease, and exports decrease. Yet you are likely to see the withdrawals of savings and imports increase. It should be noted that a reduction in the interest rate will have the opposite effect. So in other words, all these arrows in blue will be pointing in the opposite direction when there is a reduction in the interest rate. However, when people are particularly pessimistic about the future state of the economy, they may prefer to keep hold of their money, of the money they already have, rather than spend or invest it, and they're unlikely to want to borrow any more. In this case, lowering interest rates won't create the above ripple effect or have an effect on the transmission mechanism, and monetary policy will become ineffective. This situation of holding money is known as the liquidity trap. A solution to it is quantitative easing, which I will discuss later in the video. It should be noted also that markets affect interest rates as well, not just the Monetary Policy Committee. The bank rate is the lowest rate at which the Bank of England will lend to financial institutions, e.g. banks, but it isn't the rate of interest that you'd pay if you apply to a high street bank for a mortgage or took out a bank loan. However, these various types of interest rates are linked. If the bank rate goes up, then that will usually lead to interest rates charged on mortgages and bank loans also increasing. The same happens in reverse if the bank rate falls, i.e. other interest rates in the economy will also fall. But the bank rate is not the only thing that affects these market interest rates. For example, banks often need to borrow the money that they lend out to firms and consumers from other lenders. If lots of banks are trying to borrow money at the same time, then they'll have to pay a higher rate of interest themselves, which will affect the cost of mortgages and loans they offer to consumers. At this point, it may be worth Googling what is meant by crowding out. Interest rates directly affect exchange rates. When interest rates are high in the UK, big financial institutions such as large banks or insurance companies want to buy the pound. They do this so that they can put their money into UK banks and take advantage of the high returns for savers brought about by the high interest rates. This is likely to be a short-term movement of money and is called hot money. An increased demand for the pound means its price is going to go up, i.e. the pound's exchange rate rises. Unfortunately, a high exchange rate makes UK exports more expensive. So to explain this, suppose the exchange rate of the pound against the dollar is £1 equals $2, and suppose a British firm makes pens that cost say £1. It costs £1, beg your pardon. To buy one of these British pens, someone in the US would have to buy the pound. This would mean that the price of one of these pens in the US is effectively $2, since it costs them $2 to buy £1, and they can spend this £1 on buying a pen. Now, suppose the exchange rate changed to £1 equals $4, i.e. the pound's exchange rate goes up or the pound becomes stronger. Someone in the USA would now have to spend £4 to pay for the same £1 pen. Remember, the pen's price in the UK has not changed at all. It's still £1. This extra cost to the person in the USA is all to do with the cost of buying pounds. So, when this happens, exports go down, worsening the current account on the balance of payments. That's the UK's current account. For the same reason, but in reverse, high UK interest rates means imports from abroad become cheaper. Again, this worsens the current account. And remember, imports are a leakage from the circular flow of income. And so more spending on imports means a reduction in AD and a possible negative multiplier effect. When the UK interest rate falls, the opposite happens. In other words, when the exchange rate of the pound falls, UK exports increase as UK goods become cheaper, and imports decrease as foreign goods become more expensive. The current account on the balance of payment improves. At this point, you should remind yourself of the acronym SPICED: strong pound, imports cheap, exports dear. The knock-on effects that a change to the official bank rate can have are best shown by the transmission mechanism. That is, the transmission mechanism shows the effects of the interest rate change. The end result of any change in the official bank rate will be a change to the level of inflation or deflation. In my diagram, this is referred to as price developments. So, I'll give some examples there to illustrate the point. Suppose the Bank of England reduces the official bank rate. Other interest rates, e.g. mortgages, and savings rates will probably fall too as a result. This affects asset prices, e.g. prices of houses and shares. These are likely to rise, i.e. the positive wealth effect, since people tend to buy more assets when interest rates are low. Although it should be pointed out that if mortgages go down, demand for houses is likely to increase, pushing prices up, and if interest rates fall, savers will see shares as a better way to get a return on their savings. Anyway, people and firms will also generally feel more confident about the future, which will make them want to spend or invest, leading to an increase in domestic demand. Lower interest rates will also generally mean a fall in the exchange rate for reasons already described, which leads to an increased demand for UK exports. The result of all this is that total demand in the economy increases, that is, aggregate demand increases. The price of imports will also generally rise as a result of a fall in the exchange rate. The end result is that there's upwards pressure on the level of inflation in the economy. Monetary policy needs to look about 2 years into the future. The effects of changing interest rates is not felt straight away. It takes time for the effects to feed through the transmission mechanism that we've just looked at. For example, reducing interest rates won't usually cause a sudden surge in investment or house buying. Firms plan investment projects very carefully. It can take months or even years before they increase their spending. House buying can also take a long time. People need to find a suitable home, and the purchase can take a long time too. Moreover, fixed rate mortgage holders won't notice the effects of an interest rate until their fixed rate period ends. In fact, the time lags between changes in the bank rate and its effect on the economy can be very long indeed. The maximum effect on firms is usually about 1 year. The maximum effect on consumers is usually felt after about 2 years or as little as 18 months. So the Bank of England has to look roughly 2 years into the future when making a decision about interest rates. Funding for lending and forward guidance aim to stimulate lending. After the 2008 financial crisis, bank lending to households and businesses was falling, which contributed to slower growth. Funding for lending and forward guidance are policies to encourage lending with the aim of stimulating the economy. Funding for lending was launched in July 2012. It involves the Bank of England lending money to commercial banks below market rates with the intention that these cheap loans will be passed on to households and businesses. The scheme was closed for household lending when the government decided the housing market had recovered, and was also adjusted to favour lending to small and medium-sized businesses over large corporations. The success of funding for lending has been questioned. More mortgages were approved and mortgage interest rates fell, but there may not have been much benefit for the wider economy. However, without the scheme, things might have been worse. Forward guidance involves the central bank publicly announcing its intentions to keep the base rate at a certain level for a set period of time, or while certain economic conditions remain, e.g., while unemployment is above a certain rate. The aim is to allow businesses and individuals to plan their borrowing and spending without having to worry about sudden changes in interest rates. The Bank of England has used forward guidance since 2013. Quantitative easing, QE, injects new money into the economy. It should be noted that before you look at this quantitative easing section of the video, that you have an appreciation of how bonds work. So it's worth having a quick Google now about how bonds work. What is meant, for example, by a coupon, what is meant by a maturity date. Okay, so continuing with quantitative easing. Quantitative easing, QE, is used when it's necessary to adopt a loose monetary policy to stimulate aggregate demand at a time when interest rates are already very low or negative, such as they were in Japan. Okay, so the point is here we're facing the liquidity trap. People are saving despite a low interest rate. It's also worth noting that QE is not simply an attempt to print money to pay national debts, as some people would suggest. Okay, so QE increases the money supply, which will enable individuals and firms to spend more. It involves the Bank of England creating new money and using it to buy assets owned by financial institutions and other firms. The hope is that they will either spend the money or lend it to other people. QE was introduced in the UK in 2009. Aggregate demand needed to be stimulated after the 2008 recession, but interest rates were already at a very low rate of 0.5%. The Bank of England bought assets, for example, government treasury bills known as bonds, from firms such as insurance companies and commercial banks. However, QE was slow to work at first because the banks were still reluctant to lend money after the credit crunch. Instead, they used it to increase their reserves of money. Eventually, these banks did begin to lend money to other firms and individuals who used the money, for example, to invest in new machinery, start new businesses, or buy houses. All of this spending boosted aggregate demand and led to an increase in the rate of inflation. The diagram on the screen I will explain in detail once I've finished this overall explanation of QE. Using QE to bring up the rate of inflation rather than decreasing interest rates has the added benefit that it will keep a currency weak, i.e. its exchange rate will remain low. This can increase the competitiveness of an economy and boost exports. QE also provides a boost to overall confidence in an economy, especially during a recession, as consumers and firms see the central bank taking action. One danger of using QE is that financial institutions may initially use this new money to increase their reserves and only lend it out when the economy improves. This extra lending at a time when inflation may already be increasing can lead to demand pull inflation becoming harder to control. So let's explain the quantitative easing process one more time. If you look at the bottom left of the screen, I've noted that the Bank of England purchases existing government and corporate bonds held by pension funds, banks, and insurance companies in order to pump money directly into the financial system. Funds are then credited to the investors' accounts, that is, the people who sold these bonds, the insurance companies, etc. This will improve their liquidity. Consequently, asset prices will start to rise. There will be a sense of that these companies' shares are now worth more because these poor assets, these assets that weren't making much money, have been taken off the insurance companies and the banks' books. Therefore, the share prices of the company and other assets will start to rise as more money enters the system. What happens then is banks lend more as a positive wealth effect occurs. The banks are now optimistic because they've been recapitalised and they're more willing to offer loans. What's the consequence of this? Well, the consequences of this are that bonds increase in value and yields decrease. Simply, we've said that asset prices increase, bonds are a type of asset, and therefore the yield on the bond will fall. The consequence of this is first that lower yields push down borrowing costs for businesses, This can act as a stimulus for consumers and firms to start borrowing again and, more importantly, spending. It should also be noted that investors will switch to other assets with higher yields, such as shares. Now, the shares, as part of a company, the shares will become more attractive because the idea is now that the economy is moving and the companies become more profitable. Remember that shares increase in value when it's deemed that a business is profitable. So what's the consequence of this? The new liquidity is redirected towards sellers of bonds and shares. The rise in the yields of other assets, such as shares, creates a wealth effect, hopefully a positive wealth effect, with holders of assets experiencing an increase in their wealth. This increases their confidence and stimulates spending. The possible effects of this may then spread out into the real economy. So, in a nutshell, quantitative easing is about resolving the issue of the liquidity trap and to inspire confidence in firms and banks and consumers to borrow and lend, therefore driving AD to the right and avoiding any possible risk of deflation. Okay, so that comes to the end of the video. Thank you very much for listening.